So as I'm recording this video, high interest rate credit card debt is skyrocketing in the United States. So many people are saddled with bad debt and they're wondering how they might navigate it, pay it off, and find a different way of handling finances. Well, the good news is many people don't realize that part of the infinite banking strategy is actually recapturing your money and in the process recapturing debt, particularly bad debt. In today's example, one of our experts, Denise Boisvert, is going to talk about a 4-year strategy that she used with Lenny to recapture $30,000 of bad credit card debt into a policy, eventually pay back the policy and have a personal banking resource to replace high interest credit cards. Pretty exciting stuff. So we're going to dive in with Denise, then I'll be back to offer some action steps. This applies to you. Take it away, Denise.
Thanks for the intro, Steve. Denise Boisvert here, Insurance and Estates Pro Client Guide and Coach. I get a lot of calls from prospective clients looking for an efficient way to get out of debt. I want to highlight one of my recent clients, Lenny, who had 3 credit cards with a totaling debt amount of $30,000. When I told him he could have this debt completely paid in approximately 4 years without taking any additional money out of his pocket each month, he was pretty skeptical. As we know, the credit card has become a necessary evil for a lot of folks who just can't seem to make ends meet. However, as we also know, it's a temporary band-aid that escalates into a much bigger problem. High credit card interest rates, 20 to 29%, quickly increase our debts and create a spiral downfall for many. So it makes sense to teach people like Lenny how to get rid of that never-ending debt in a manageable way and move forward on a much more financially healthy path. We started by looking at what Lenny was paying on his current credit cards monthly. Then we worked on redirecting those amounts gradually into a vehicle that will allow him to build cash value and borrow from himself at a fraction of the interest costs. Looking at this chart, we took the required minimum for each card and decided that would be the amount he would send to the credit card companies each month. He was currently paying more than the minimum, trying to get those balances down. We will take those extra payment amounts and redirect them into a high cash value life insurance or infinite banking strategy. By doing so, we're building up a cash value account that he will be able to borrow against and pay himself back, reducing the interest rate dramatically. So if we take a look at these numbers, he has 3 credit cards. He has credit card debt at Home Depot for $5,000. He also has a Discover card with a $10,000 balance and a Visa card with a $15,000 balance. We want to look at the minimum required amounts that need to be paid on each of these cards. So Home Depot, the minimum requirement is $100 a month. He's going to pay the $100 a month, and then he's going to take the extra. He's currently paying $300. He's going to take the extra $200, and he's going to redirect that into a high cash value life insurance policy. He's going to do the same thing for his Discover card. The minimum requirement is $200. He pays $400. We're going to take this extra $200 and put it into the policy. And on his Visa card, the minimum is $300 a month. He pays $500 a month. So we're going to redirect that $200 also into the life policy. So his minimum payments are $600 a month. His current payments with the overpayment he's making is $1,200 a month. And his new payment is going to be the $600 a month minimum payment plus $600 a month into his infinite banking policy or his high cash value life insurance. So it's the same out-of-pocket expense. He's just putting his money in a different area. So let's just take a look and see how that's going to work. So his goal year 1 is to pay off his Home Depot credit card of $5,000. He's funding it $600 a month, which is the $600 minimum payment, plus the $600 that's going into his cash value. So his year 1 cash value is $50.98. And here's his cash value right here, $50.98. He's going to take $5,000 and he's going to pay off his Home Depot year 1. In year 2, he's going to take that $100 that he was putting into his Home Depot, and he's going to add it to his infinite banking plan, his high cash value life insurance. So now he's putting $700 a month into his plan. At the end of year 2, his cash value is $11,898. And his loan availability is not going to be $11,898 because he borrowed $5,000 last year. So his loan availability is $6,898. So he's going to make a partial payment on his Discover card. He owes $10,000. He's going to make a $6,000 payment. Year 3, he's going to continue funding it that $700, but at the end of year 3, his cash value will be $19,575 minus the amount he borrowed. Year 1, $5,000, and year 2, $6,000. So he has around $8,500 available. He's going to make the remaining Discover payment of $4,000, and he's also going to put $3,000 towards his Visa balance. So now he no longer has the Home Depot card or the Discover card, so he's just freed up another $300. So now he's putting $900 a month in year 4 into his infinite banking plan. At the end of year 4, his cash value is going to be $30,602 minus all of the loans he's taken out in the past. So his loan availability will be $12,602, and he owes $12 on his Visa, and he will pay that off. So the end of year 4, he has all his debts paid off. But now he has debt in his life insurance policy, right? He hasn't paid any of those loans back. The nice thing about this is he can decide how much he wants to pay back. Now, if he was smart, he would continue making that $900 a month extra payment into his policy and paying those loans back. But he doesn't have to. He can do it however he wants. Basically, the money in his cash value is compounding, earning interest and dividends. So his loans are pretty much a wash because the earnings are kind of counteracting the loan interest rate, which is probably only going to be around 5.5% compared to the 29% he was paying in his credit card. So now he has the freedom to pay however much he wants. He could actually have paid this off faster if he threw in extra money into his life insurance policy each year. So instead of just basing it on what he's paying his credit cards, maybe he got a tax return, maybe he got a gift, maybe he got a bonus from work, and he put it into his life policy as long as it's designed to hold it. And he actually paid those debts off as he was going along without taking any initial money out of his pocket. So what he has ended up with is a policy that is going to continue to build cash value. He's going to want to continue to make the premiums for this policy because it's a great place to have your money. It's growing tax-free. He's going to always have that loan availability. In year 10, if he wants to take out another loan, he never has to use credit cards ever again in his life because he's going to use this policy as his credit card, which he is in control of, and the interest is really low, and he can pay it back whenever he wants. Keep in mind also, he has a death benefit that he didn't have obviously with a credit card. So if something happened to him, his family would have, a legacy or money that they could use to make up for any income that they had lost because of his passing. So a lot of advantages. There's so much more to these policies. Today, I just wanted to address how we can use these to pay off debt. Because if we keep paying the minimums on our credit card, folks, they are never going to get paid off. So I hope this was helpful. If you want me to look at your situation and design a plan to pay off your debt, please let me know. And I'm going to turn this back to Steve, and he's going to give you a recap of what we talked about.
So if you've got credit card debt and you watch that and you're not a little bit excited, I want to just politely suggest that you go ahead and watch it again, because that was so cool how Denise illustrated for Lenny how she was able to take basically his minimum payment, have him keep paying those credit cards, then take the extra and fund a policy, and within a year be able to start paying down that bad credit card debt, and then doing basically a different version of what you might know as a debt snowball, basically to eventually repay all those credit cards, and then to put that full amount into a policy as additional paid up additions. So really dig into this. If you have credit card debt, if it's a concern for you, you can always look at your own numbers and see how you can create a strategy with Denise. Wherever you're watching, there's going to be a calendar link below that you can schedule. I encourage you to do that. Thanks for watching. I'll see you in the next one.